Most wealth managers sell complex because complexity justifies fees. Well, our next guest on Wealth on the Move, the podcast, Ben Carlson, argues that simple beats complex and behavior matters more than spreadsheets. Check out this episode of Wealth on the Move, the podcast. Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. Welcome back to another episode of Wealth on the Move, the podcast. I'm your host, founder and president of Hoffman Wealth Management, Will Hoffman. And today I'm really excited. Our office has been buzzing all day, getting ready to talk to today's guests. Admittedly, I have a couple fanboys in this office when it comes to his podcast and the firm that he works with. Just to give you a quick introduction, today's guest is Ben Carlson. Ben is the director of institutional asset management with Ritholtz Wealth Management. Sure the name is familiar to you. Ben is one of the hosts of the Animal Spirits podcast, along with his friend Michael Batnick. In addition to that, he is the author of 4 books about saving and investing money. The first is Everything You Need to Know About Saving for Retirement. Don't Fall for It, which is a short history of financial scams, organizational alpha, and a wealth of common sense. And we're going to talk about his new book that's releasing in May called Risk and Reward. Ben was also a winner of Investment News' 40 Under 40 in 2017. So you can see why we're so excited to have him join us today. So without further ado, Ben Carlson, welcome to Wealth on the Move, the podcast. Thank you so much for joining us.
Thank you. And I'm no longer under 40, so that was a one-time deal.
Yeah, those expire. I didn't get one, and now it's too late. So I've got a few years for hopefully a 50 under 50, and then that ship will have sailed as well. So thank you again for joining us. I know you're a busy guy with a lot going on. Can you give us a little background about Ben Carlson and what your role is with Ritholtz first and foremost?
Yeah, so I've been there a little over a decade. I'm part of the investment committee. My background is in the nonprofit space. And then I started writing and blogging just to kind of have an outlet and to further my learning, and realized that there was a desire for my work in wealth management. And actually, the first people who emailed me about my blog back in the day were financial advisors saying, hey,
Okay.
kind of like what you're doing here. I like how you explain it in plain English, because my first audience was my, family, friends, people outside of finance. That was my idea. Because I keep getting all these questions as the finance guy for everyone else.
Right.
I want to explain it in a way that regular people can understand it. My grandmother, my mother, my father-in-law, people in my life that ask me these questions all the time. And so that was the idea. And a lot of people said, hey, our clients are just normal people too. They don't work in finance. They're not paying attention to this stuff every day. I like that you're explaining it in plain English. And me being in the nonprofit space at the time, I wasn't even thinking about it in that context. And I kind of, the light bulb moment for me, like, that makes sense. People want to take the complicated, complex stuff and explain it in an easy way. And my roundabout way to getting there was, it was way too complex for me in the institutional space. I thought people made it way more complex than it had to be. There was this idea that, like, you're a more sophisticated investor. People love that word, sophisticated.
Right.
If you do the more complex stuff, it's more complicated, you're more sophisticated. And I thought, this doesn't match reality. There's no way this is true. Yeah. So that's kind of how I came into wealth management. I got to know Josh and Barry and Michael because they were doing content as well. And we realized, like, we have a similar philosophy. We have similar values. We have similar ideas about how clients should be treated and how markets work and all this stuff. Let's bring you into the fold. And that's how I got to where I am today.
And the blog, it's still active, right? The Wealth of Common Sense blog.
I'm writing. Yep, I'm writing. I find, someone once said that I write to find what it is I really think or believe. And writing is, when I first started, it was kind of cathartic for me because I was in a place where I wasn't, happy with the way that things were going in my industry. And I wanted to, figure out a better way. And so writing is a thing that I need. It's good for me, I feel like. And so that's why I write a lot.
Okay, awesome. And now the new book coming out, Risk and Reward. What's the premise of this book, and why is it so necessary now?
I've been writing for a while now, and I've been espousing the idea of long-term investing. And one of the blog kind of came about because there was so much negativity in the world coming out of the great financial crisis. And I lived through that. And I understand why it happened, because it was a very scary time. We had 50% plus crashes in the stock market within the span of like 9 years, right? It was a scary time. And I felt like there was so much pessimism and so many people telling you why the system's broken and everything is rigged against you and long-term investing is broken and doesn't work anymore and all these things. And I said, well, that's not what I learned, and that's not what I think. So I wanted to be more kind of a glass half full person. And along the way, I constantly, every time I post something about the benefits of long term investing, I get people saying, "Yeah, but what about this? And what about that? Did you think about this? There was this time where this happened." And people want to constantly poke holes into it because I say that buy and hold investing is the worst investment strategy there is, except for all the other ones. Right? It's so
Right.
it's not. It's like that's like I'm paraphrasing Churchill there. It's there's a lot of bad stuff that comes and goes with it. Like you have to take all the good with the bad and the bad with the good. But I still think it's one of the better ways of going about it from like a baseline perspective. But I think for a lot of people, it's so hard to do that they would just rather throw their hands up and fight back. And I get a lot of this exception and that exception. And did you think about this? And it doesn't work because of this. And so this book is like me trying to play devil's advocate with my own investment philosophy. Like I'm trying to poke holes in it and show all the really nasty, gnarly, bad stuff that can and has happened and will happen in the future and why it still makes sense to think and act for the long term.
Right. I mean, that's one of the famous images that all of us advisors use is that that image of the performance of the S&P 500 and all of the negative events over the course of time, from from famine to world wars to pandemics to presidential assassinations to all of these things. And while it's not a straight line, that line's still moving up and to the right.
Yeah, and
And
the
there's
point
always
is,
a day to not invest. There's always a reason not to, but it's been wrong every
yeah,
time.
and the point is that like the history of investing is inclusive of all this bad stuff, right? If you look at the last 100 years, and the U.S. stock market is up roughly 10% per year. That's not just picking and choosing and cherry picking the best stuff. It includes all the nasty
All the
crashes, all the
crap, right?
inflation, all the everything bad, all the really bad days and bad months and bad years. And I go through all that stuff. The whole point is to like open the kimono and show you, like, no, it's not going to be easy. Like there you can simplify your investing process, but there are some really uncomfortable, hard times when investing. And then here's some context around them, and here's how to sort of try to hedge those risks. But that's the idea that, yeah, even with all the bad stuff that's happened, you still get this wonderful long-term outcome, and it's still the best wealth building machine on the planet.
Right. And right now, everybody's trying to be a geopolitical expert. And 6 years ago, we were all pandemic experts and I can't say the word epidemiologists or we all understood viruses better than everything, and we didn't have to worry about any of that. We didn't have to do any of that. We just had to buy, hold, put our heads down.
It's funny though because that's like one of the point of like the next risk is almost never what the last risk was,
Right.
and it's because everyone after my whole experience with the Great Financial Crisis was after it happened, everyone said, "All right, I need a black swan fund, and I need like downside volatility hedge, and I need all these things that I wish I would have done." And of course, the next risk is nothing like you thought it was. And if you would have laid out what's happened this decade in terms of like the landmines we've gone through, you mentioned the pandemic and 9% inflation, and oil goes from being negative to like shooting to $150 a
Right.
barrel almost, and all these crazy scenarios. We have tariffs, and we have all this stuff we're dealing with, and the stock market is still up double digits, almost the same exact annualized return as it got in the 2010s, with a totally different environment, right? 9% inflation and all this stuff. And I talk about in the book that I think it's probably never been harder to like you said, put your head down and ignore the noise because it's constantly we're beat over the head with it, right? We have the
Right.
little supercomputers in our pockets now, like constant alerts. And so to me, it's not even so much like ignoring the noise anymore. It's finding the right filters so you're not like just focusing on them to your own detriment.
Right. Well, and that's I mean, what we're trying to accomplish here, and that's what you guys are trying to accomplish is creating the right noise, the sensible noise. I mean, hence the title of your blog, The Wealth of Common Sense. I want to talk about one of the signature blogs that you did write under The Wealth of Common Sense about Bob. Can you tell our listeners a story about Bob and his investment experience?
Yeah. One of the other reasons that I wrote the book, it's funny. It, if you remember, the stock market peaked before the Great Financial Crisis in October of 2007. We didn't hit
Right.
new all time highs again until I think March of 2013. So it was a long time. And
Yeah.
then when we hit those new highs again, everyone said, "Oh no." One of these highs is going to be just like that high was, and we're
Right.
going to fall off a cliff. And so people thought, no one wanted to believe that, and even I don't think I would have believed if you would have told me in 2013 that this thing's going to go on for until the mid 2020s and maybe beyond this bull market with some setbacks along the way. But people thought like, okay, it's going to end now, right? Double dip, whatever. And so I said, well, okay, fine. What if you do happen to invest at a peak and you have the worst luck in the world? What happens if you only invest then, but you hold, right? And so I made this story up about, and I didn't even, it's so funny when I write these posts, sometimes I'll have the data in mind and I'll do the data and then I'll write the blog post. And sometimes I have the idea in mind and then I'll run the numbers, right? And for this one, it was more the idea. And I wanted to kind of see, well, what does it look like? And the numbers were way better than I thought. So this guy only invests, he had 40 plus years of investing and saving, and he invested every time right before a huge crash. And he held his money, but then he kept it in the market. And the point was the fact that he kept it in the market, even with these really bad timing trades, he still ended up a millionaire just by the fact that he kept the money in the market over so long a time frame. And it's by far my most read blog posts ever. I still get like 100,000 people who read the post every year. And I wrote it in 2014. And it's funny, we actually number of years ago did a video on it to like make a cartoon of this story. And our production team was looking at it the other day and seeing how it's doing still. And I scrolled through some of the comments and people say, and a lot of the comments are the same. It's like, okay, great. That's in the US. The winners write the history books. Things did great there. But what about a place like Japan? And what about this scenario? What about the lost decade and all this stuff? And that's one of the reasons that I wrote the book, because everyone wants to talk about the exceptions to the rules. And I think do think it's fair game, but I think you don't want to get to the point where you take those exceptions to you invest exclusively on them, right? You're paying attention to the stuff that happens 5% of the time or 2% of the time or whatever, and basing your baseline exclusively on that. So that was the point of the book is let's go through these really worst case scenarios and the outliers and talk them out a little bit.
Yeah. I mean, and it's just a tremendous lesson for investors, whether you have been doing this for a 40-year career or you are just getting started and making your first 401k contribution today. Tremendous lessons for folks to learn from. I do want to pivot to Japan. You mentioned it in the last conversation. You've talked a lot about Japan on your blog. I think Now Show Japan, is that one of the episodes or something that you did or not episodes, but let's talk about that a little bit and your opinions and insight on Japan and how it plays into the book.
It's funny. It would have been a little too inside baseball, but I told my editor, like, what if we just called the book Now Show Japan? And they said, that's a little too much of an inside joke. I think no one would really get it. And wait, what is this book about? And that's the thing is that you have that was not only a lost decade, it was a back to back to back and then some lost decades, right? Plural. And people look at that and they say, okay, this is why buy and hold or long-term investing doesn't work. Because you had this period of long-term returns that were just awful. And, the Japanese stock market didn't hit new all-time highs after topping out in 1990. They didn't hit new all-time highs until last year, right? Which is crazy. And that's the one that people throw in my face all the time. Well, yeah, what if you did this in Japan? How would have Bob done? And I think actually like that outlier of Japan actually shows like the power of buy and hold investing even more, because at the peak in 1989, 1990, Japan was the largest stock market in the world, 45% of the total, right? Which is where the US was heading into this bull market, like right around 45%. So in 1989, Japan is bigger than the US in terms of market weight. And it fell all the way from 45% to I think 5%, probably lower than that at the lows. Now it's 5 or 6% of the total, maybe. It's a much smaller percentage. Maybe depending on what we're looking at.
I have the blog pulled up right now, but that was in 2016, I think.
Yeah. It's probably a little higher now. Japanese stocks have actually done pretty good the last decade or so. But even with that, one of the biggest developed economies in the world, the stock market does nothing for 3.5 decades. The MSCI World Index still gives you like 9% a year. Again, inclusive of that Japan situation. Right. So, and if you look at I show this in the book, the problem with the Japanese stock market is that the returns were so compressed and so high. And the chapter of the name of the chapter for that one is like the biggest asset bubble of all time. I really think Japan, that bubble makes anything that we've gone through in America look like child's play. Yeah. How crazy it was. It was the stock market. It was the real estate. The funny thing is there haven't been a ton of books written about it. A couple here and there I found, but not a ton like you'd think about like the Great Depression or something like that. And maybe because it wasn't like an event, it was like this long drawn out thing, right? It didn't happen immediately. It happened over the
Right. There
course of
was no
many
black
decades.
swan, and it was just a lousy 3 decades. There
Yeah,
was
it was a
no
slow burn. It was like
sinister,
death by a thousand
or
cuts.
no victim, or no villain that you could pinpoint.
Yeah, it was a process, not an event. But the returns were so compressed that in the night from 1970 to 1989, you got like 22% per year in Japanese stocks, which is insane. Like you can't compound your capital that high. I think the number I found was small caps in Japan did like 30% a year for 20 years, like
Wow.
putting Warren Buffett to shame.
Right.
Two
For
decades. And so you compress the returns in such a short period of time. The mean regression to the mean was really mean, because then the next 3.5 decades were basically nothing, like 1.5% per year. But the total over that like 55-year period, if you started in 1970, was still close to 9% per year. So like the very long term actually still worked in Japan. It's just the returns were so compressed into the beginning that the returns at the end had to be really, really bad to compensate for that. And again, I think the biggest lesson for Japan is not necessarily that buy and hold doesn't work. It's that if you put all your eggs in one basket in one particular strategy or region of the world, you could have a really bad outcome. And diversification is like the simplest way to hedge against that risk.
Yes. Yeah, agreed completely. Thank you for tuning into this episode of Wealth on the Move, the podcast, brought to you by Hoffman Wealth Management. Here at Hoffman Wealth Management, we focus on working with busy families and active retirees, helping them navigate the complicated scenarios of their wealth while building the life that they desire. And we believe that every financial journey deserves direction. That is exactly what our proprietary process, the HWM navigation formula, provides. Just like a GPS, our navigation formula begins with 2 key questions. Where are you now? What does your financial picture currently look like? And where do you want to go? What goals and dreams do you have? From there, we help you navigate every financial turn en route to your desired destination with clarity and confidence. It's more than a plan, it's a personalized path forward. If you want to learn more on how the navigation formula can work for you, reach out through the contact options in the show notes below. We would love to help you chart your next move. Now, back to this episode of Wealth on the Move, the podcast. So I want to switch to our profession a bit. What do you think that most wealth managers get wrong when it comes to managing money or helping clients manage money?
I think I've seen the biggest transition I've seen, and maybe I'll start with myself in this. When I first entered the industry, was people need help understanding the markets and the economy and building a portfolio and having like portfolio management. Like that's what people need help with, because that's what people were worried about coming out of 2008, and that's where you can add value. And I wholeheartedly agree that that stuff is still very helpful to clients. Like they need someone to explain how this works, how investment strategies work, how the market works, providing context and setting expectations and all that stuff. I think you can absolutely add value on portfolio management. The thing that I totally underestimated coming into this line of work is how important the financial planning aspects are.
Yes.
And most clients come to you thinking, yes, I need someone to manage my portfolio for me. But no, it's like I need someone to manage my portfolio within the context of this broader comprehensive plan that includes a financial plan and includes helping me out with all these other needs, taxes and insurance and estate planning and passing money on to my kids and charitable giving and all these questions. That stuff matters so much more than the portfolio side of things. And I think I personally underestimated just how important those things are. And I think a
Well,
lot of
because
clients
that's almost
realize that
every
too.
inbound call now. Every inbound question that a client has is rarely, why is this holding underperforming? Or should we get more access to AI? Their questions are not in understanding the markets. It's trying to understand themselves and trying to
Yeah.
understand how this money impacts them, not how the world impacts their money. And that's been a big shift again, post financial crisis for our firm has been, all right, we're done talking about the markets for right now, hopefully forever, but you and I both know there's going to be some sort of
Yep.
other
That
event
still
with
comes
that,
up.
but it's making sure that they understand themselves when it comes to their money is mostly what our
Yeah,
inbound calls are
and that's
now.
and it's not everyone, of course, but I think that's one of the big things that the industry has gotten right. Like, what do you where do you see holes still in our industry where people are doing the wrong things?
So, as a independent RIA, anything with a conflict, anything commissionable, anything to me is, I mean, I guess if that commission is transparent and everybody understands what's happening, then it's clean. I want to see the conflict go away and have it be more about the client and less about the firm. More about, I don't like, our firm, we don't have sales goals, we don't have AUM goals. Our goals are strictly impact. How are we impacting our clients' lives from a day-to-day basis? If we keep measuring that, my dad taught me that lesson early on. He owned a property and casualty insurance agency for 51 years. And he said, if you are taking care of your clients, the money will take care of itself. And nothing's been more true. I wish that would wave over our entire profession when it comes to how we treat our clients.
Yeah, and one of the big things that we try to do, and I didn't really believe it early on when I joined, but the people that I worked with said we're going to be really, really cognizant of client fit, and that it's going to be a two-way street. Like, we
Yeah.
want clients that want to work with us. We all want to work with them. Like, we don't want to take a client on that is going to request something of us that we can't or won't do, right?
Right.
Because there are plenty of advisors who do things certain ways, but like some of the things that we just we won't make promises about certain things, and other advisors will. And I think taking on a client that you know you shouldn't is like not only a waste of your time, it's a waste of their time, it's a waste
Sure.
of everyone on your
Well,
team's
that
time.
and we've done it. I mean, every advisor's done it in
Yeah,
the
everyone has. Yeah,
history of their growth, especially when you're young and early on, and you're hungry for every client that you can get, but it never works out. You're
right.
always stressed that you're outside of your bandwidth. You're worried that you're doing something that you don't know how to do, and it never works out. And it's not. You're right. It's not worth it for any of us.
Yeah, I had a my first introduction into this. One of my first jobs, I worked for a small independent consulting firm in the Detroit area, and my boss at the time had some Detroit Tigers that were like, that's, hey, would you like to talk with these players and maybe manage their money? And we, at the time, we were doing some family office stuff, mostly institutional clients, pensions and endowments and such. But we'd take on a family office client here or there. And they introduced him to a pitcher who everyone knows by name, or knew him in the 1990s at least. And people know he's from Detroit. And he said, hey, he wants to talk with you. He likes the way you do things. And my boss said, absolutely not. I worked with a professional athlete once. It was a terrible experience. I've decided I'm not doing it again. I know that this sounds irrational and I probably should be doing it. And me, as a young person in the industry, is going, are you crazy? And he just had this rule. That was one of his rules, that just, I'm not going to work with those types of clients, because the time I did, it was just a total time suck for me and it didn't work out. And even though, so I think having some of those rules like that in place, of the type of clients you will or won't work with, that was really eye opening for me, because I thought, like, this is insane. Why would we not take this professional athlete on? This is awesome. It's cachet
Right.
and all,
It's exactly what we're trying to do every day. Right.
Yeah.
So, I guess to compound on that question one more time, what do you think advisors should stop charging for?
Well, that's a good question. Um, what we try to do is just have it be kind of all in one, as much as we can. Like, clients ask, like, am I going to be charged if you do this for me? Am I going to charge if you do that for me? We want it to be like, no, what we do is it's all under one roof here. And so I think one of the places that the advisor practice has gone is that, it's funny, for years people have said, oh, fees for advisors have to come down. Like, it's going to follow like the mutual fund index fund
Right.
route. A lot of people in the fund industry made those predictions, right? You guys are next. We were first. You're next,
Yeah.
and it hasn't come to fruition. And I think one of the reasons that it hasn't come true is just because they had it backwards. It wasn't that fees were going to fall; it's that margins were going to fall, and advisors were going to be expected to do more services, right? If we're coming to you, we want you to be like a one-stop shop for us and do everything. And we want more services, and I think that is kind of where we're going in the future as technology continues to improve. Is just that clients are going to expect more from their advisor. They don't want to have to go to somewhere else to get advice. They want you to be the one to provide it, you to be
Right.
one to provide the service, provide the technology platform, whatever it is. That's what I think everyone wants is like, I want to be under this one umbrella, but I don't want you to like nickel and dime me for this and
Right.
that and add on and add on and add on. They want like this. No, this is part of my fee. And as the advisor, I expect you to provide this additional service for me as part of
Yeah.
my
That
fee.
aggregating the wealth adjacent services has been one of the main bullet points of our year this year is trying to be the not necessarily the authority on all those areas, but be able to aggregate that for our clients when it comes to accounting and tax. And we get deep into the Medicare stuff, those areas, and helping them understand how this impacts all of it, because like you said, the market is one component, but so much is impacting their wealth right now, and they want to know how all this works together.
So I'll give an example for our firm. We were getting requests from clients to do tax returns for a number of
Hmm.
years, and we were very hesitant to do it because our thought process was you make one mistake on a tax return and like that client is gone, right? It
Yep,
can be a
they're gone.
yeah, people hate tax mistakes. It could be $100 or something. They'll never forget it, right?
Right.
Um, so we found a person who Bill Artzeroni is his name. He did it for another RIA. He came in, he built the practice out for us, and we very slowly rolled it out. And we went to we went to like 100 clients first to like just make sure that this works. And I think the response was like 99% yes. People just said yes, please just do it. And we were kind of we didn't know what the response would be, and the idea was just like yes, just I don't want to have you talk to my CPA and have to. And so it was kind of eye opening that people wanted to have it under one roof and do it. And again, we were pretty hesitant to do it because we didn't want to screw things up. The funny thing is, it actually kind of helped the client relationships because we were finding mistakes that other people were making. Because it
Right.
was kind of like, listen, you know the portfolio, you know the investments, you know what's going on in my whole financial life. You should be able to understand this better than anyone. So it's interesting how much people are like, yeah, just do it all for me. I want you to handle it.
We're in the infant stages of that right now. With we brought on we just called it an integrated tax solution with a company out of Virginia for the same reason. We don't want to be the ones doing it, but we know that we need to work together and much more closely than just getting their CPA, their existing documents for the previous tax year. So, and we're in the beginning stages of rolling that out now. And because I was as hesitant as you guys were, that I just don't know that this is something that I want to mess up. I know I'm not going to be doing the taxes. So finding the accountant to do the
Right.
taxes, and then, we've taken on too many clients who had that messed up at other firms because they were unhappy. You touched on this earlier, and when you talk about with we didn't hit a new peak until 2013 after the financial
Yeah.
crisis, and you talk about fighting the last war, and folks still preparing for another financial crisis and still preparing for that. What do you think the last war that investors are fighting right now in 2026 is?
It's funny. I feel like this decade has completely flipped the scripts. In the 2010s, it was people were worried about what can go wrong
Sure.
and when's the next crash going to come, we almost have a big new generation of investors now. And now it seems like the prevailing wisdom is just whatever happens, it's not going to matter, and things are going to come back immediately. And because we've had these like V-shaped rallies, right?
Right.
And anytime something goes wrong, the government's going to step in or the Fed's going to step in and someone's going to fix it, right? And part of that I think is just markets moving faster and there being more coordination among fiscal and monetary policy and these things. So that's definitely like a change in the market environment.
Yeah.
And a lot of that stuff doesn't happen if 2008 doesn't happen, right? Because I think they learned, right? It's like
Right.
each crisis we learn something. But I guess the way I view it is risk never completely goes away. It just kind of changes shape and changes form. Uh, and so I do think that like my worry is that like there could be some complacency, uh, that, people think it's markets are too easy and just every time something goes down, you buy it and come back up right away. So that'd be a concern that we've been on just a crazy, crazy run in US stocks for more than a decade and a half now. Like we're closing in on 2 decades almost, right? Of just
Right.
really, really good returns. We've had bear markets along the way, but they haven't been long lasting. We haven't, is my contention is we haven't had a real recession since 2007 to 2009, right?
Yeah, I mean, the COVID, it's hard to count that as a recession. I understand technically
Yeah,
it
but
hit
the
all
government
it
threw so much money at businesses and
right.
individuals, and I mean, there was people who were making more money on unemployment insurance than they were making at their jobs. So that's why the labor market came back so quickly. So we haven't had like a real economic cycle in like 17 years. And I just my only and I hate to be the guy like wagging his finger and you just wait, you kids,
Right.
because whatever, everyone has to learn these things. But I'm curious to know what the reaction will be if we do have like a more drawn out, even a regular recession with a uh, run of the mill sort of recessionary bear market that the market falls 35% or something and doesn't bounce back right away. I'm just curious what the reaction will be. I think that's the war everyone's fighting now is just every time something falls you buy and it comes back. It's easy.
Yeah. I mean, you're constantly a calming voice for your listeners, for your readers, for other advisors. Do you think that's cost you anything professionally by being that rational, reasonable? Listen, guys, it doesn't have to be this complicated voice for investors and for, like I said, other advisors.
Yeah, I think there are probably plenty of clients out there. And again, I ran into this a lot in the nonprofit space. Just that a simple option for them isn't just they can't wrap their head around it. Like how can you simplify something and make it this easy or not easy, but I need the complex stuff. There has to be like a holy grail, a secret path, something that and they're just constantly in search of like the next bigger, better thing. So I'm sure there has been some of that, but I also think that investors have wisened up a lot, and not everyone, but a lot of investors I think are more well behaved than they were in the past. And I'm not trying to like take credit for that myself. I think there's been so many people who have been beating that drum for the last
Yeah.
20, 30 years or whatever that a lot of it has, led to improve
Well,
where people aren't freaking out like they used to.
I think that has come just from watching, millennials watching their parents, where boomers didn't get to watch their parents navigate the market because they retired with a pension and social security. They picked their date, complained about being on a fixed income for 20 years, and then that was it. So baby boomers did not have that witness that they could follow and say, well, remember when this happened and dad didn't panic. Now I'm not going to do that. And we're starting to get farther and farther away from that. And they're learning these lessons. Their narratives are changing internally when it comes to the market and money. And they're, oh, shoot, you're right. The market stunk in 2008, but I was an idiot for selling out at the wrong time. So
Yeah.
they've learned from this, and they do hold the ground a little bit whenever you have a 2018 or a 2022 or something.
Yeah, and I think young people are actually more attuned to volatility. Like if you think about all the young people who got their start trading like crypto, right?
Right.
It's a 24/7 market and there's been, 70, 80% crashes, multiple in that space.
Right.
I actually think people who went through that kind of stuff are just more immune to the volatility and are more okay with it. And I think that's a good because that's what advisors have preached over the years is like, listen, the volatility is just that's like the price of admission, but you have to learn how to deal with it
Yeah.
or de-risk your portfolio to the sleeping at night point. So yeah, I think young people do have an easier time dealing with it. And I think it's probably for the better. Now, are there still like degenerate people who are speculating and taking the wrong lessons and doing way too much? Of course, but I think
Sure.
on the
But that's
whole,
always going to happen. Right.
yeah, of course. But I think that on the whole, like things have gotten better, and I think the numbers show that people under the age of 40 are investing in stocks more than ever, which I think is a great thing, is if they stick it out for a long time.
Yeah. So you wrote something called 20 Things I Believe About Investing. Can you pick 3 or 4 of those from those 20 things for our listeners before we close out?
Yes. So I mean, the big one was just like the simple over complex. That's my thing that I will take to the grave. Right? It
Yeah.
is just.
No, I'm with you, buddy. That's
And it's not again the complex strategy can work. I think it's just harder. I think one of the harder things for investors to do in a more complicated strategy is lean into the pain. And I've been enough coming from the nonprofit space. I've been in enough of the board and investment committee meetings where they have like the color coded, right? It's green and it's yellow and it's red for the funds or strategies, right? And red means,
right.
hey, we're getting out of this manager. Yellow means they're on the watch list and green means they're doing good. And usually it's all performance based, right? This one's performing
Right.
bad, so we're gonna get rid of it. This one's performing good, so we're gonna keep it. And the yellow one is not performing great, so we're gonna watch them. And I think the hardest thing to do with a complicated strategy is go, actually, the one in the red who's performing poorly, we should rebalance the portfolio and sell a little bit of the green and go to the red, right? Because that's the
Okay.
allocation we chose. And I think if you're in a simpler portfolio or approach, it's much easier to make that decision than it is if you're in something complicated and you just go, all right, fine, we'll do something even more complicated and get rid of this one. So that's something to. The other thing, I think one of the bigger ones is just, and I've just witnessed this firsthand, it's just how hard it is to predict what's going to happen in the economy.
Right.
And there's a lot of people who are way smarter than me at like forecasting and tracking the economy, but they're not, they can't tell you what's going to happen because there's so many unintended consequences and different variables. And frankly, the economy is so big now, it's like turning a battleship,
Right.
right? There's so many, it's a 30 trillion plus dollar economy. It's very wide and diversified, and people take their own personal anecdotes and try to apply it to the economy, but it's so big and it's so diversified and there's so many different touch points. I just think it's harder than ever. And we saw in 2022 when you had the headlines of like economists say 100% prediction of a recession. It didn't happen. And there's so many different ways now to slice and dice the data than we had in the past, right? Like
Right.
it was so much more high level. Now you can like get so into the weeds on the economic data and understand like here's this number, but here's also the 50 components that make up this number, and here's what it really means. And I think I've just learned that anyone trying to predict the economy is just it's just a
They're on
it's
fool's
kind of
errand. Yeah.
it's a fool's errand. And even if you had like the economic data ahead of time, I don't think you would make money off of it because it's you never know what the market's reaction to it is going to be or how many
Right.
times it's going to be changed and updated. And
Right. You hear a good jobs report, and the market goes down. Like you get this good news becomes bad news scenario over and over again. That you're right. You can't trade it.
yes, and I think the other one really is just like I think the whole maybe point of my book is that um, you can poke holes in any investment strategy, but you have to invest in something. Right, you can't
Yeah.
like the one way to guarantee bad results is to just sit on your hands and do nothing, right? And bury the money in your backyard or find reasons to not invest. And that's the hard part about the market is like you're taking a leap of faith in a lot of ways.
Sure.
You know, I tend to think one of the reasons I invest for the long term is because I think the future will be better than the past. I don't know for sure if that's going to happen. I think it's a pretty reasonable assumption, but if you don't think the future is going to be better than the past, I don't know why you're really investing for the first place, right?
Yeah.
That's the whole point of it.
I mean
That
that's
people,
the whole precipice of the painting that's behind me that a great friend of mine did. It's called Permable because it's not just the market. It is everything 10, 15, 20, 40, 50 years from now. I believe is going to be better than what we're looking at now.
yeah.
And
Even though
most
in that
investors do.
even in that 40, 50-year period, we're going to have a handful of recessions. There's probably going
Right.
to be a financial crisis. I was talking to someone last week. I was saying I find it hard to believe that there's going to be a worse financial crisis than the 2008 one in my lifetime. But I can't say that for sure.
Sure.
Like as
Yeah.
scary as that was, you never know what's going to happen. I think that's the point too. Is that's why my book is kind of like a yin and yang. That was the risk and reward type of thing. Is like you have to look at both sides too. You can't just stick your head in the sand and pretend like hope these things won't happen. These bad things, like
Right.
they definitely will. But that's part of taking risk. And the stock market wouldn't offer you such high returns if those risks didn't exist.
Yeah. What's the phrase? The risk is the toll we pay to be on the market highway. And
Yeah, right?
that's
Price of admission? Yeah,
yeah.
I totally agree.
So before we close out, my audience is they're advisors, they're folks building long-term wealth. Who are two or three folks in your world that you think my listeners should hear from next?
Okay, well, I'll start with, like, my original favorite who I think taught me a lot of it's funny, every time I think I've, like, come up with this novel concept, realize this guy did it 20 years before me. Jason Zweig at the Wall Street Journal has always been kind of a finance hero of mine. I love the way that he writes, the way that he explains things. Um, I leaned heavily on his book, Your Money and Your Brain, for my book in a couple sections. He looks at like the neuroscience of how your brain reacts to certain things, right? And
Okay.
how losses and gains impact you. And my favorite one is just that he says that They did brain scans of a person who was making money, and it's indistinguishable from someone who's high on cocaine or methamphetamines. Like the everything popping when you make a lot of money, it's the same
Yeah.
thing. And it's like that's why people continue to trade because they need to get that high, right? And so Jason Zweig at the Wall Street Journal is of course one of them. My colleague Tadas Visconta at Abnormal Returns, I think, is a great place. Advisors always say, like, I don't have enough time to pay attention to everything. Like, what do I do? He writes his blog Abnormal Returns. He's been doing it for like 20 years, and he just aggregates everything else. So if you want to know what the best stuff to read on any given day or week is, he puts it all in one place, and he's taking the best of whatever else out there. He's doing 7 days a week, and then on Sundays he does like here's the top 10 most clicked on stories. And I think it's a great way to just stay informed. He uses financial publications and blogs and newsletters and all these things. And I like the fact that he just aggregates the best of everything that's out there. And he's been following his stuff forever, so he has a good eye and ear for it.
Okay.
And so that's a good way to. He's like your own little AI that gives you the best stuff to read every day.
Okay.
He kind of aggregates it for you. And then my other colleague Nick Majuli, he does his dollars and data once a week. He has a great newsletter where he only posts
Nick
his
was
own
actually
blog.
a guest. He was on our show a few weeks ago. We had Nick
Okay,
on with his book.
Yep, and Nick blogs once a week, and he also does a newsletter where he's sharing some of the best of what other people read too. And yeah, that's where I get the most of my ideas for other stuff. It's not like me coming up with brilliant new ideas. It's reading the best of what's out there from other people too. So I appreciate people who are willing to share and the stuff that they're reading and paying attention to.
Yeah, great stuff. So, where can our listeners find and follow you and find the book? May 12th, right? May 12th
May
is
12th it comes out. Yep. I did the audiobook actually. So if you're one of those people, I'm a convert to audiobooks. All
okay.
my nonfiction reading is going on. I put in my earbuds and I walk around and I listen to books. So I thought about having some British guy read it for me because he probably would have sounded better with the accent. But I said, you know what? I do the podcast. I should do this. And it's funny because I do have my publisher is based in London, Harriman House.
Yeah.
And so I have a guy in my ear from London who's one of the editors and he's telling me, hey, read this again. Hey, you messed this word up. And he's my producer or whatever. And he's they do a ton of different books. So he's not a finance guy. And as I'm reading through all this bad stuff that's happened in the markets, and then I'm trying to explain it, the whole premise of the book is like one chapter is bad stuff, and the next chapter is like good stuff in context. He goes, hey, I'm not like a markets person, but listening to you talk about the Great Depression and Japan and all these bad things is making me really anxious. I was like, good, I guess I'm bringing about feelings.
So it was working, right?
Yeah. So anyway, so I did the audiobook. Yeah, you can get it wherever, Amazon, Barnes & Noble. It'll be out May 12th. You can hear me. So I Kindle, paperback, Audible, all that stuff. Then I'm still blogging at A Wealth of Common Sense. You can sign up for the newsletter there, and anytime I write something new, you get it to your inbox.
Awesome. Well, before we do sign off, I want to reference something that's right behind you. Right above your head, there's a picture of the Three Stooges playing golf. And my office and my entire life history, essentially, is in the town where the Three Stooges got their start.
Okay, where's that?
Tiny little town east of Pittsburgh called Jeanette, Pennsylvania. There was a park where there was an amphitheater where the Three Stooges performed for the first time, and Mo and Shemp actually lived in town here for a while.
Really? Okay.
Yeah.
So I used to watch the show with my mom when I grew up. That was
Okay.
that kind of humor. It just I feel like it's timeless.
Yeah. Yeah. So they got started in the town in Jeanette where our office is located.
Oh, that's
And
cool.
I couldn't let this show wind down without referencing that because I could see the bottom half of the photo above you. And
my wife got me that photo when we were dating, so I probably had that picture with me for 20 years now.
so, see, now you got to come visit. You got to come visit the office.
All right, they got to have a museum or something. Huh?
There's a big the Historical Society has a big museum downtown that has
That's pretty
some
cool.
references to them. Yeah, one of our claims to fame. Well, thank you so much. I'd love to have you back in a year to see how these ideas have aged and have another conversation and maybe have another book to talk about at that point.
Cool. I hope not, but maybe we'll see someday. Nothing will come back on that I want to book in a year.
If anything, we'll see you in September out at Future Proof. We're looking forward to that trip. Our whole team goes out and had the time of our lives last year and already excited for this year.
Awesome. All right. Well, thanks for having me on.
Check out Ben's book. If you have any questions or anything about anything you heard here, please reach out to us. I'm very active on LinkedIn. You can always find us on our website at hoffmanwealth.com. And until the next time, please remember to keep your wealth moving. Ben Carlson and Ritholtz Wealth Management are not affiliated with Hoffman Wealth Management and Private Advisor Group. Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.